Good morning, everyone. Welcome. So, in our past few sessions, we've really built up a solid foundation in the nuts and bolts of business math, right? We've talked about profit and loss, interest, algebraic modeling, all of those tools you need for day-to-day management. But today, we're going to take a pretty big leap. We're moving from the tactical into the strategic. We are stepping into the world of calculus, which is a branch of math that lets us do more than just describe a business. It lets us model and predict how it changes over time. And specifically, we're going to focus on this concept called integration. Trust me, by the end of our time here, you'll see why this isn't just some abstract math problem, but an absolutely critical tool for anyone who wants to lead a major company.
Okay, so I know exactly what a lot of you are probably thinking right now. Something along the lines of, hold on, I'm a business major, not a math major. Why on earth do I need to learn about integrals and functions? And you know what? That's a totally fair question. It's one every business student asks. Your focus is on marketing or finance or HR. You want to learn how to read a balance sheet, not a calculus textbook, right? Well, the answer is found in the very nature of business itself. See, business is never static. It's always in motion. Costs go up and down, revenues change, market demand is constantly shifting. Integration is the mathematical language we use to understand and, more importantly, to quantify the total cumulative effect of all these little changes. It's the tool that lets us go from a simple snapshot of right now to a full-blown forecast of the future. Getting a handle on this will give you an analytical edge that your competition, the ones who only see the surface-level numbers, just won't have.
So here's our game plan for today. We're going to start with a concept that should feel a bit familiar from your intro economics classes: thinking at the margin. From there, we'll build a bridge from that micro-level view to the macro-level, big picture. And that's exactly where integration comes into play. Then we'll look at some concrete, real-world examples where integration isn't just helpful, it's absolutely essential. After that, we'll hit pause and talk about a very common mistake, a pitfall that can have some serious financial consequences if you're not careful. And finally, we'll pull it all together to see how this math tool becomes a real strategic advantage out there in the corporate world.
All right, let's dive into our first section, thinking at the margin. Really, at its core, so much of operational business decision-making just comes down to this one simple idea. What's the impact of the next thing we do? Should we hire one more person? Should we make one more product? Should we put one more dollar into that ad campaign? That's the whole game right there. That's marginal analysis. Let's kick things off with marginal revenue. So as the definition says, it's the extra cash you bring in from selling just one more item. Now let's translate that into the language of calculus. Marginal revenue is what we call the first derivative of the total revenue function. Okay, let's break that down. A function is just a rule that connects two things, right? In this case, it connects the number of units you sell to the total money you make. The derivative of that function tells you the instantaneous rate of change at any single point. The best analogy is the speedometer in your car. Your total distance traveled is a function of time, but your speedometer, that's the derivative, is telling you your speed at this exact second. So the marginal revenue function tells us, with incredible precision, how fast our revenue is changing at the exact moment we sell unit number 100 or unit number 500. It's a super precise but also a very, very narrow piece of information.
And you guessed it, the exact same logic applies to the other side of the equation, marginal cost. This is the first derivative of your total cost function. It tells you exactly how much more it costs to make that one additional unit. Now, the golden rule of microeconomics, and really of any smart business, is that you keep producing as long as your marginal revenue is greater than or equal to your marginal cost. Think about it. If selling your 1,000th product brings in $50 in revenue, but it only costs you $30 to make it, well, that's a $20 marginal profit. You absolutely make that product. But what if, for the 1,000 first unit, you have to pay workers overtime and your material costs go up a bit, and suddenly the marginal cost jumps to $60? Well, now you'd lose $10 on that one specific unit, and that is your signal to stop production. This constant comparison, it's the very heartbeat of an efficient, profitable operation.
But here's the catch with marginal analysis. It's fantastic for making decisions about the very next thing. But what about the bigger questions? What if your CEO walks in and asks, what's the total impact on our revenue if we ramp up production from 1,000 units a month to 5,000? Marginal analysis can't answer that. It's too focused on one single point in time. To answer questions about the total change over a whole range, we have to flip the script. We need to use the inverse of differentiation. We need integration.
To really get the connection between marginal analysis and integration, I want you to think about it with this analogy.
Imagine your marginal revenue function is a single super high-resolution photograph. This photo, which is our derivative, it captures one precise moment in time, say the sale of the 101st unit with perfect crystal clarity. You can see every single detail of that one instant.
But that photo, as clear as it is, doesn't give you the story. A single frame pulled from a 2-hour movie tells you almost nothing about the plot, who the characters are, or how it all ends. It's the same idea here. Knowing your marginal revenue for the 100th unit doesn't tell you a thing about the total revenue you made from the first 99 units. And it definitely doesn't let you predict the total revenue you'll get from selling the next 500. It's just a single data point, floating without any context.
And this is where integration comes in and really shows its power. Integration is the mathematical process of taking all those individual frames and stitching them together to show you the complete movie. It systematically adds up the marginal value of every single unit over a range you define, the first one, the second, the third, all the way up to the very last one. And what you get isn't just a snapshot anymore. You get the entire film of your revenue or your costs. It turns a static, one-moment analysis into a dynamic, full story of your business over a range of production.
Okay, so let's get out of the abstract and into the practical. How does having this movie of your business actually help you make those huge, high-stakes decisions that can make or break a company? This is where all the theory we've been talking about becomes an absolutely essential tool for senior management.
So as you can see here, the applications are pretty fundamental to corporate strategy. Let's take that forecasting example. Imagine you're a company like Tesla. They have incredibly sophisticated models for the marginal revenue they get from selling each additional car. But to decide whether or not to drop billions of dollars on a new factory, they need to know the total expected revenue from selling, let's say, the next 500,000 cars. To get that number, their financial planning team will literally integrate that marginal revenue function over the range from 0 to 500,000. The number that pops out of that integral, that's the total revenue forecast that goes right into the investment proposal for the board of directors. This is not a hypothetical classroom exercise. This is the core of how major capital budgeting decisions are made.
This slide here basically lays out the playbook that a manager would follow. Let's walk through a scenario. Imagine you're the product manager for a new smartphone. Step 1, your data science team crunches the numbers and gives you a marginal cost function. Let's say it's C prime of x equals 0.01x squared minus 2x plus 300. This is just a formula that tells you the cost of producing any given phone X. Step 2, you then do the math, you integrate that function to find the total cost function, C of x. Step 3, now the fun part. You can use this new function to answer the big questions. You input your planned production run, maybe it's 50,000 phones. By calculating C of 50,000 minus C of 0, you get the total variable cost for the entire project. Step 4, you take that hard number to the finance team. They add in the fixed costs, they compare it to the revenue forecast, and together, you figure out a pricing strategy that ensures this new phone is going to be a profitable hit. Every single step here is crucial. Now, before we wrap this up, we have to talk about a really crucial detail in the integration process. It's something that often gets glossed over in introductory math classes, but it has massive, and I mean massive, implications in the business world. I'm talking about the constant of integration, that little letter C you see at the end of the formula. Forgetting to account for C when you integrate a marginal cost function is probably the single most dangerous mistake you can make with this technique. Look, in a classroom, forgetting the plus C might cost you a few points on an exam. In the real world, in a corporate setting, it could lead to a multi-million-dollar miscalculation and could literally bankrupt a project. Why? Because in business, C isn't just some random number. It represents your total fixed costs. It's the rent for your factory. It's the salaries for your admin staff. It's your insurance payments. It's all the money you spend before you even produce a single item. When you integrate your marginal cost function, the answer you get only tells you the total variable costs. You have to manually add in that constant C, your fixed costs, to get the real, true total cost. If you ignore it, you will be catastrophically underestimating your expenses and creating a wildly optimistic and completely false projection of your profit. It's a critical step. So let's pull all of this together. The main point, the thing I really want you to walk away with today, is that what we've been talking about isn't just a math lesson. Mastering integration is about fundamentally changing how you look at and understand a business. It's about developing a quantitative, strategic vision that will truly set you apart from your peers.
Let me put it as plainly as I can. Marginal analysis is the tool of the tactical manager. Integration is the tool of the strategic leader.
The manager who gets marginal analysis can optimize today's production run. They can answer the question, should we make one more? And that's a valuable, profitable skill. But the leader who understands integration, they can accurately forecast the profitability of an entire new product line over the next 5 years. They can answer the question, should we even enter this new market? And that ability, that leap from the immediate and tactical to the long-term and strategic, that's what separates a good manager from a true visionary.
So, to wrap up our session, we've defined integration, we've seen how it's different from marginal analysis, we've explored how it's used to make huge strategic decisions, and we've highlighted that critical pitfall of accounting for fixed costs. So the question I want to leave you with is this. In your future careers, how are you going to use this powerful tool to move beyond just making simple, reactive decisions and start architecting the long-term, profitable future of the companies you're one day going to lead? Thanks for your time and attention today.